Good morning, everybody, and welcome to Avondale's webinar this morning, Private Equity Demystified. My name is Kevin Uphill, and I'm the chairman of Avondale Corporate. So thank you for joining this morning. It's getting cold out there, so hopefully we can warm the room up a little today with some tips and ideas on private equity and where the market is and what we're seeing out there. I'm joined today by two of my colleagues, Roshan Puri. Well, he's not actually a colleague, but we work with them, YFM Equity, big private equity provider, and also Simon Baldwin, who's one of our deal leaders, who's done a couple of private equity deals recently, so sharing some of his experience of the direct and live journey. I've got about an hour today. Please fire questions as we go. Don't feel frightened to heckle us if you don't understand what we're talking about. And that is quite simply, private equity demystified in an hour is actually quite a tough challenge. I'm reminded of a joke once. I asked one of my sort of private equity contacts to explain the private equity model to my client, and he quite rightly said, "What, without a spreadsheet?" Which very much sums up the difficulty we've got this morning with demystifying private equity. For those of you who don't know Avondale, we help people buy and sell companies. We specialise in what we call the emerging mid-market. So that's companies with an enterprise value of 2 to 50 million, typically profits of £500,000 to 10 million kind of range. And really the higher end of the SME market. So typically 20 plus employees, etc. Why that focus? We're very passionate about it. We believe that these businesses are the engine house of the economy going forward. It is a lot easier to scale up a business with 20 plus people than it is with two. So private equity, what is it? And a bit more of an introduction. So, I mean, private equity simply means money that's not in public sectors. I was explaining to my 14-year-old son yesterday, difference between the London Stock Exchange and NASDAQ. You know, these are public markets, shares are traded daily, the shares are listed. Private money is investing in private companies, private equity going into private companies where those shares are not liquid, they're not being traded daily. Increasingly, private equity has become professionalized into what is called private equity firms. And these are partnerships that manage people's funds on a professional basis. So you are appointing them as an investee to go and find companies to invest in and get a yield on the business. The emerging mid-market, as I say, is really significant because it's a real key area for scale up. It is a lot easier to build returns and growth from there. So I just realised my video has been muted, so my audio has been muted. Guys, have you had that? Roshan, did you hear me?
Yeah, loud and clear. It doesn't look like your audio is muted for me.
Okay, well, my video was muted at my end, so I'm just going to look and see if any other panelists, it's just showed that. Could well be that it's just my computer being strange. Private equity is money going into private companies with a view to seeing how you can create a yield, ultimately with most of those yields coming for a future sale. There's about 100 private equity in the UK specialising in the emerging mid-market, but then of course you've got US, we also have a number of Nordic, European private equity firms. And there's 2.3 trillion of money looking for a home in private companies. So there's more money almost than there is opportunity, which in itself is a challenge we'll explore later. So private equity, that's a background as to what it is. Why is there so much money? Well, fundamentally, private equity is investing, right? People investing in companies looking for a yield. Ultimately, that yield is normally in the capital growth of the business rather than necessarily the income. But in the last 10 years, private equity has outperformed all other investment classes, and that's why more money is piling into it. So over stock markets and property, private equity has outperformed, so there's more money going into it. People are very interested in how you create a yield in this private company market. Where is it used? Well, we're seeing it used in a number of different ways. Simon will talk later about Tarfix. That's what we call an elevator deal, but ultimately, you may have seen their vans and vehicles on the road, but they do commercial vehicle repairs. Very, very successful company. And our guys were looking to sell it and then realized actually private equity might be a better route. I'll let Simon explain that, but that's an elevator deal, so we'll talk about that later. Ultimately, also management buyout. So a lot of people, the first shareholders have said, right, that's it. We've had our round. We're looking to hand over to management. Private equity can help that management buy in where bank debt can't afford to do the transaction. You've also got the growth capital route. So I guess that means an elevator deal is where you might be selling more than 50%, so it's more of a sale than it is an investment, whereas growth capital probably less than 50% coming into the business to help it scale up. And of course, there are still deals that are being done which are overall sales. So we've done a number where sellers don't want to continue, they don't want to reinvest in a sort of elevator type deal, and those have been 100% sale to private equity, but all with a view to scaling up and taking the business to the next level. Private equity are looking for businesses where there's a capable management team. That doesn't mean it has to be you if you're a shareholder or your client's a shareholder and you're looking to exit. Very often we tag team the MD, CEO at the point of taking in private equity. We're looking for this 3x, and we're looking at 2 to 50 million enterprise value typically, often increasingly with this buy and build strategy being employed. So a buy and build strategy is you buy into a company, you're looking to get a 3 times growth over the next 5 years. One of the fastest and best ways to do that is increasingly through acquisitions. As markets are slow, organic growth is slow, acquisitions bring that possibility to scale up. And of course, because of the sheer amount and volume of money, the war chest is there to do acquisitions. But they are very focused on capable management teams, and we're looking at, particularly your second tier, what is their ability to scale that business up? Really important. So with private equity, you've got to have a growth story. Of course, private equity is not for everybody. Are you a seller? Are you a partial seller? Are you an overall seller? Are you on growth capital? All of this depends on your business cycle. We will, after the event, be sending out a sort of little pros and cons flyer sheet, which is the bit on the right-hand side. The font is deliberately too small because it's too complicated, but we'll send it out as a PDF, which is, if you're looking at your exit options, are you private equity, MBO, employee ownership, or trade? I think probably the balance of it is private equity is more of an ongoing journey. Values can be very, very similar to trade, but the key with private equity is you get a second bite of a cherry in terms of potential future value, whereas trade, more often than not, is all cash out. But private equity do compete well with trade today in terms of valuation. I mean, clearly, if you've got a trade buyer, we want, we need, and you've got intellectual property and you've got recurring revenue, trade multiples will be higher and it becomes harder for private equity, but they do compete very well. And in fact, this year is the first year we've done more private equity deals than we have trade. I think that's because trade are a little distracted with all of, the sort of COVID recovery process we're all going through. And private equity also has so much money, it is able to compete very nicely in terms of deal structure. So private equity, why are they doing this? What's their motivation? We all have the opportunity to invest in private equity business. And effectively, and I like to think of them as the property developers of the business world. Of course, they're interested in income and yield, but ultimately, it's what's our future exit? How do we create capital value? So again, when I was talking to my 14-year-old son yesterday about London Stock Exchange, I said, look, are we going to be buying shares for dividend, or are we going to be buying shares for capital growth, or a mix of both? And actually, private equity tend to fall in the capital growth side. So buying the shares with a hope that they can flip them later. typically within a 5-year period of 3 or more times whatever they put in. So if we put in 10 million, can we turn that into 30? Typically over a 4 or 5 year period. Now, we are seeing some more patient capital. So not all private equity is focused on that, next sale flip. But a key to how you get that 3x return, you buy into the business, it creates a de-risk or a partial exit for the seller. You then work out how to grow that business, scale it up. Organic growth will create part of that yield. Acquisitions will create part of that yield. But another key area is multiple arbitrage. So where they're buying, because it's a slightly smaller company, at multiples of 6 or 7 or 5, then can they sell out on a price earnings multiple of 10 or 11? And then, the bigger the earnings, the higher the price earnings multiple as a general rule of thumb, because the perceived perception of quality of earnings, sustainability and infrastructure is stronger. So private equity are buying with a view to knowingly get multiple arbitrage on their investment. Buy at a low price earnings, sell at a high price earnings. Again, going back to my 14-year-old son and the explanation of the London Stock Exchange, and it has PE in all the tables on the stock. And I said, that's price earnings. He said, no, Dad, PE is private equity. And I thought, do you know what? This is finance. All this jargon we have to use and acronyms makes it difficult to demystify. But actually, if you stick to the terminology, it's not as complicated as it seems. One myth about private equity on this return is the idea that you are going to have to be the person that grows the company. It may well be that this is, when you do a sale, particularly if it's an elevator type deal, i.e. a majority exit, that is the time that you tag team into an agreement on a new CEO. Or often it's agreed that you might, as a selling team, stay as CEO for a year and collectively you will recruit. Don't necessarily have to have that CEO in place from day one. Okay, so let's look at a specific private equity deal. We've put up here, this is not a growth capital one, this is a more majority sale. So anything between 50 and 100% would be a majority sale. We call them elevator deals, because you get a chance to elevate your value over the duration of the deal. So you're not just selling out, trade deal, all cash today. You get a chance to elevate as you go. This is very typical, and the Tarfix example was an elevator type deal. So I've used here for this example, I've used an EBITDA, that's an earnings of 2.5 million. That would be adjusted for seller costs. And I've used a PE multiple, price earnings multiple of 6, and we got to a 15 million value. Now, of course, we would go to market. That price earnings might be 5.5, it might be 6.5. You go on an offers basis, the market decides. But assuming it's a multiple of 6, we get a 15 million enterprise value. And in this case, because we think we're growing, we think the EBITDA might be 3 million by the end of next year, we actually actively adopt an earnout as part of the deal structure. We ring fence the business so that we can protect that earnout, and we're largely in control for the period. A typical earnout, 1 to 2 years, they can vary, 1 to 18 months, that sort of period. So we've got 10 million on day one. That would be your seller de-risk, 2 million earnout, so we've got the 12 million value. And of the 15 million, we choose to reinvest 3 million, which is called rollover, into the new co that's going to do the acquisition that private equity have established to do the acquisition. Now, we've all agreed that this business might scale up through acquisitions, so it needs a war chest to do that. So we negotiate and agree that the company from day one will have a 5 million war chest. So the total capital value in this business is 20 million, although the enterprise value is 15, the deal value and total capital value is 20 million. We've chosen to reinvest or roll over 3, so 3 on 20 million gives us 15% of that new co. So we've de-risked, we've sold out for 10 on day one, we've got a bit of earnout, we've got to make sure we continue a bit of growth in the short term to make sure we get more of that initial sale, but we've chosen to reinvest, go on a journey over the next 4 or 5 years and see if we can join in on that 3x plus journey to elevate our sale value over time. Let's translate how that actually looks when we get to that 5-year period and elevate a deal. I'm mindful no questions coming in, so please fire in questions as you go. We're going to be chatting later, so please bring that in as we go. So this is the elevation. So we've done sale 1, which is, I'm a retiring seller, but I'm not quite giving up. I'm thinking that I might want to retain a stake, go on a journey. I've actively gone out and sought either trade or private equity. I've been open-minded. I've looked at both. And actually, the more interested, and the more time's gone on, I've got more interested in private equity. Because it's a journey, I want to stay involved and see where the business goes. I don't necessarily have to be CEO for that long term. We go 5 years in, the war chest has been successful, acquisitions have occurred, the organic growth has continued, and we're now at 7 million earnings after 5 years. Private equity has helped us professionalise the business. We'll talk about that more and how they do that shortly. So later, we get a sale at a multiple of 10. That's multiple arbitrage and go. We had 6, and now when we exit, we're at 10 because we've got higher quality earnings. We're bigger. We've got a stronger management team. We're more perceived in the marketplace as a stronger business. But also, we're now selling to buyers who themselves are trading at higher multiples and have deeper pockets. So the value's gone from 15 to 70 million enterprise value. But the initial stake, the initial capital structure, the original 15 million buyout, plus the war chest of 5 is 20. That will come off the deal value at the end. So we'll actually have an equity value when we cash in at 50 million. So the 17 and the 3 that we've rolled over will come off. We'll have a 50 million equity value. But we sold for 70 million. The 15% of the 50 million gives us an elevator for our 15% that we effectively kept or reinvested. So we've got £7.5 million on top of the initial 12 million deal that we had. But we also get our 3 million that we rolled over back. So we're back to, we had actually our initial deal turned out to be 15, and we've elevated our equity stake by 7.5 million. So the overall deal value to the sellers there is 22.5 as a deal value, plus a bit of interest on the loan note that we rolled over. I appreciate this is complicated. We're always happy to chew the fat and give you advice on this as it is right for you or your clients. But the key here is you've had a sale to, which has given you a second bite of the cherry, and that's the key mechanism behind private equity and why people today look at them more than they do an exit, an initial trade sale as the only route. So just to summarize with some of those terminology, enterprise value is the initial total deal value, but equity value is that value minus whatever the capital structure is to do the deal. Typically, that's in loan notes or preference shares. So the way to think of it is the initial deal value is almost like a mortgage against the company. And then when you sell the house later, you've got to pay that mortgage off. And there's interest on that mortgage. And ideally, you want to negotiate you're on the same terms as the private equity firm are doing with that mortgage, which is either by loan note or preference shares. We choose to roll over. We get a choice, whether it's 30%, 20%, 15%, and see where we get our second bite of the cherry. But we also get an initial cash out, a de-risk. And I think I'm going to re-emphasize de-risk in a minute, because for me, with private equity, the de-risk is something that's not talked about enough and is absolutely critical in why we might look at these kind of deals. Jargon, as I explained to my 14-year-old son Dominic yesterday when we were talking about share buying, we started talking about buying Volkswagen versus Volvo, and because of the whole battery car trend versus Tesla, we agreed Tesla was overvalued. We liked Volkswagen. But he was showing me the Volvo share price, and their products are excellent, I have to say, and it's been really a strong performer. I said, Dominic, we've just formed an investment committee. We're now debating, do we agree with the value? Are we going for it? Which one are we going for? That's an IC. Private equity very often use the term IC loosely. If you ever hear it used, it's an investment committee. War chest, you've heard, that's the funding for growth or acquisitions. Most deals in private equity will include a ring fence of shares for sweet equity, which is a share for the management. And the reason for that is they recognise that the quality of management will want some sort of equity play. Arbitrage, we've mentioned that before, that's the multiple, the price earnings multiple going up as the earnings in the business goes up and the quality of the earnings go up. So I'll give you an example of an elevator deal. We have got a couple of questions coming, so I'm going to flip into a conversation in a minute with Roshan and Simon so that you can also ask your questions and we can chew the fat on some of the things we're actually seeing occurring with private equity. But before I do that, we're often asked, what's it like living with private equity and where do they really add value? And it's a really, it's a tough question, and one probably we should ask Roshan later as a private equity representative in the room. But as I say, for me, private equity, there's a lot of conversation about how they increase reporting, improve board governance, very commercial, less cultural. So by that, they're incredibly focused on accountability and delivery from the team. That may mean some of the team that you had don't get to survive the transaction. But then in the end, that may be good for the business because ultimately we need a management team that are capable of driving the growth, and accountability and delivery are really, really key to that achievement. But I think there's something else going on, and this is a Kevinism, but it comes back to that point about de-risk. I think the important thing is that many of the emerging mid-market businesses that we do this with, they're at 500,000 or 1 million or 5 million profit. That is a very good lifestyle for the sellers. The incentive and motivation, if you've got a great dividend yield, to scale up and triple X your business isn't really there. You're doing well, you've got great yield. For most people, it's enough money. Why carry on gambling in the casino? So the growth risk ratio is wrong for those emerging mid-market, and they fall into very often lifestyle business mode. I'm not criticizing that. I think it's a very obvious and natural thing to do, particularly perhaps more in the UK. We're not quite like the Americans where unless it's $50 million, we're not interested. We're not quite as financially driven as they are. So very often, highly successful emerging mid-market businesses turn into highly successful lifestyle businesses because the incentive is simply not there for the shareholders to create that scale up as they enjoy a good dividend. The beauty of private equity is it breaks that cycle. It creates the initial de-risk so the sellers have got sufficient money, called beach money, to go and buy a holiday home or enjoy life a bit more, and possibly some more time wealth, whilst you then put the business under more pressure and focus to scale up. And that is why private equity, time and time again, prove that if you take high quality emerging mid-market businesses and you go this model, you do get the scale up. And the yield that they get, going back to that McKinsey slide of why the asset class has been more successful, is proof of the pudding in that delivery. So highly successful, not just because they go from a cultural business to a commercial business, they focus better on reporting and finance and accountability, but also because of that de-risk. Okay, now we have had a couple of questions. I'll just go, before we go to that, show you that, in the last couple of years, we've probably done about 6 or 7 elevator deals. These are all elevator deals that we're showing. I think there's one growth capital. So, yeah, it is highly active as a market. People are very focused on it beyond trade. I think the one other reason that they're focused on it beyond trade is in the old days, you sold your business, you went and bought a holiday home in Spain. Well, tougher to get there now with COVID, but also you invested your money in property. Well, very difficult with tax to get the same yield out of property as it was. So actually, what do you do with your money? Well, you could give it to investment advisors, people like Quilter, all very good. St James's Place, they do get a yield. most years. But the yield is what, 5-6%. Hang on a minute. On that elevator deal, my 3 million turned into 7.5 million, and I got my 3 million back. How am I going to match that with an investment advisor? I believe in my business. I'm going to back it and take it to the next level. And that's really the key behind the private equity model. So I'm going to shut up. We're going to try and do some Q&A. It's my job to chair that. Because the webinar is demystified, if I've used jargon, I've used comment that you don't understand, it's your opportunity to sort of criticize, challenge, come in and bring through some extra commentary and deals. Roshan and Simon, welcome.
Thank you.
So thank you. Simon, is your video on?
Yeah, I think so. Hopefully.
Yeah. No, you only come on if you talk. That's great. Okay.
Okay.
So can I just go? We've had 3 questions so far, and some more coming in. So why might private equity be better than trade? Simon, can I address that with you, because you went on the Tarfix deal. Your sellers wanted trade, right? And then they went private equity. So
yeah, I think that's pretty much true. I think it's worth pointing out a lot of our clients are not up to speed with the private equity world, and why would they be? They're busy running their businesses, and then along comes the potential do I retire, or I'm getting near that, doing something else in life, start looking around at the possibility of selling the business. Early conversations is a classic with Tarfix, as with many of our clients. In their case, they had absolutely no idea about private equity. They believed that somebody would buy their business, would be a trade company. And I said, well, that's possible. They couldn't see why anyone else would buy it. And I started to sort of have the conversation about private equity. And, they weren't too keen about the idea, to be honest, to start with. We probably had 3, 4, 5 trade meetings. And then I said, well, look, let's meet some private equity and see what you think around their positioning. Because I think their mental perception was, well, they've heard of venture capitalists. That means they're going to come in and strip me out and whip my back and make me work, and it's going to be a really hard slog, etc. They had no real conception. So we had half a dozen meetings with different private equity, and during that time, within about 6-week period of having these meetings, our client suddenly turned around and said, I think on reflection, private equity is the route for us, and I'm really, really surprised that we're actually saying this. So and the reason for that was trade had been quite arrogant, I suppose, far more arrogant than private equity. I think they realised that if they sold to trade, whilst it was a potential route, it was going to be the trade company's route or the highway. It was going to be their way or the highway. And they saw that private equity was a softer route, although they were going to be very driven to grow the business. It was in harmony, and the focus was all about their business, not making their business fit our business.
Simon, in a way that's a surprise, because the newspapers love to demonise private equity. I call them the new Barbarians kind of thing as the newspapers, and yeah, it's all about the spreadsheet, it's all about the yield. Roshan, just bringing you in there, Simon saying it became apparent it was a partnership. What was your view on that, and why do you think private equity do have sorry to say, a bit of a bad rap in terms of reputation as finance people?
Yeah, because it makes good headlines, I guess, addressing that point. Books written with the headlines "Barbarians at the gate" kind of creates a bit of a picture, doesn't it?
Yeah.
In reality, there are different types of private equity. The size of businesses that we are investing in and that Avondale typically work with, it's about growth. What better way to deliver a return than growing a business? So that doesn't normally include stripping out a significant amount of cost. It normally includes investing in the people and in the capital of the business. Much larger private equity, where we're talking about merging companies of $1 billion, then that can be about stripping out cost and financial leverage and different financial engineering structures. Whereas the size that we operate in, it's all about growth. And actually, so growth clearly comes from the quality of the market and what the business is doing, its product and service, but mainly comes from the people in the business. So the main thing for us investing in businesses is, who are we backing? Who are the people? What is their plan? Can we get on board with that? And are those individuals really motivated to make this a success? Because obviously we only make a return. We only make money when the people in the business, the management team, make money.
I think that's, so the making the money bit, Roshan, is where people sort of get upset, really, you know, because it's like, you know, and we've had a question here on loan note, which is really important for private equity structure, because when first explained to people, it's like, well, hang on, you're using my own money to buy myself, effectively. So we have two questions on loan note. Do PE mostly put debt into the business, or do they put in cash? And do they always offer loan note? So do you want to just comment on the whole? I've tried to explain loan note on the elevator deal, you know, kind of like it's a mortgage and then it comes back off. But why do you guys do that?
Yeah, I think you explained it very eloquently. And I guess the way I look at it is there's a common misconception, I guess, about loan notes, because they are called loan notes. It's very, very different to bank debt. You know, it's very different to a mortgage in the nature of the debt. So it's not a secured instrument. It's not secured against the assets. The interest is commonly not paid during the period of the loan note. It's normally accrued and paid at the end and an ultimate exit. And then the loan notes themselves, the capital of the loan note isn't normally repaid over the period of investment. So they're not amortizing in the same way that a term loan from a bank might be, where you have to pay it back over 3 or 4 years. So all of that capital and interest just sits in the back of the business and is accrued until exit. And so it's not about the loan notes taking cash from the business. And actually, you know, we're all about the profits that a business generates being reinvested in that business so it can grow faster. And that's a big difference between bank debt and private equity loan notes. And then the loan notes, the fact of them being paid on exit is just about what is the capital structure that delivers that return that we're looking for. And it's, as you said, there's no surprise that we're looking to generate around about 3 times our money over 5 years, 4 or 5 years. And so loan notes create a part of that return, but are not in addition to the equity return. It's all one and the same thing, the way we look at it.
But I think you know, it's one of the, because it's slightly complicated, people get scared of it, and it's not actually scary if you break it down and you do the spreadsheet and you put it in English. It just means you got to stop and look at it. And ultimately the way to look at it is you only get your rollover money, and the private equity only get their money above whatever the initial money that was put in is. So you've got to re-earn it, haven't you? You've got to get the equity. Yeah, if the value hasn't gone up, it hasn't worked.
Exactly right. And I guess when we're looking at a business, we're investing on the basis of the future of what that business can be.
Yeah.
So we're not necessarily when we're valuing a business, we're not valuing it on today's price. We're valuing it on what's it going to be in the future, and therefore how do we generate a return for everyone in the business. And therefore, the loan note structure is basically saying, okay, you're telling us that the business is worth this much, and this is the plan that we think we can achieve. That's great. We don't necessarily know that. You know, we kind of support you and believe what you're forecasting and predicting. We don't know that, and therefore the loan note structure basically says, if the business goes backwards, then we secure some return as investors. So it's a kind of downside protection. If it goes forwards, then it's just all part and parcel of the equity return that all shareholders are looking to generate.
Okay, a couple more questions. One I think we'll address Simon from Matt here. What type of investor would purchase a business after 5 years, another PE company? Surely there is a ceiling when it comes to investors. I worry about long-term outlook for the business post-sale because of employee loyalties. Now, you've seen what's happened. By the way, when we do a deal, we go on a journey these days. With our elevator deal, we're also very happy to mirror the deal structure when we do that, because we like to join in on the journey of the exit as well in 5 years. But what's it like living with private equity afterwards? You've had some feedback on that particular example, Simon. Do you want to discuss that? And who are they hoping to sell it to? Or is that one more patient capital? What's your view on that one, Simon?
That's so just, yeah, by example, if we're using Tarfix as an example, you know, you do get different journeys. I don't know if I'm quite answering the question here, but I'll try. The Tarfix acquirer, Literacy Capital, is not a typical private equity, and I'll say typical in that the plan is to build it and sell it in 3 years' time to 5 years' time. More so, they're more the hybrid of the family investments stroke private equity. There is outside money come in, but it is also family investment funds. They've built a portfolio of about 15 businesses, for instance, and so far they haven't sold any of them within that group. So you do get the hybrid here of the longer journey. We can touch on the deal structure perhaps at the end here, as to why that works and how does the seller cash all their money in with the shares, etc. Because there's ways of doing that. But a lot of businesses, I would think it's fair to say, that go down the private equity route, you know, they've gone down that route knowing that the private equity company will be looking to diverse in 3 to 5 years' time, all being well, and that's likely to go to another private equity company. Is quite possible.
Roshan, have you ever, I mean, because obviously, you know, many of those are to other private equity firms trade. What's your view? Is it a third private equity, third trade? Is there also, have you done any IPOs out of YFM? Because I'm watching that trend.
Yeah, so we have. We've exited investments through all of those, listing a business and selling down our shareholding over time, or selling to trade, or selling to larger private equity investors that are looking to support the management team on the next stage of that journey. And actually, you know, it all comes down to what the management team want to do. Because if we're backing a team that says, you know, we just want to work really hard for the next 4 or 5 years, and then we want our beach money.
Yeah.
That means on day one of the investment, we're all sat around the table thinking about, okay, well, what's the succession plan for when your time's up? And we make sure that there is a second tier of management team that are kind of coming up through the ranks who can take the business on, or we make sure that the infrastructure in the business is right for it to be sold to trade without the level of management team that's necessarily required to run a business independently. So it's all about understanding what motivates a team, what they want to do, because ultimately, you know, if the team turn around and say, you know what, we don't want to sell to trade, we want to stay in this business and drive it forward with the support of somebody else with additional capital or something like that, we've got to go along for that ride, because we're not the ones running the business. We're there to support the team in ways that we can.
I think it's probably fair to say, is it not, Roshan, that during that first phase of, let's say, 3-4 years, it's quite common that, you know, the management that were on board with that mind of 3, 4, 5 years, or some of them were. So you might land up with that during that period of time. New managements come in for the longer journey to replace the ones that are looking to create that exit. So you land up with a hybrid of new and old management, perhaps second time around.
Yeah, that's definitely right. And there's a company in the portfolio that I'm working with where that you know, that's exactly what we're doing now. We're having, you know, we're a year or 2 years into the journey, another 2 to go, and it's about, okay, well, what's the next level of management in the business? And we've brought on a head of talent to help us identify and nurture and grow people in the business, so that when we come to exit, we've got the options, and the management team have got the options to either sell to trade or enable the next layer of management team to take the business on.
Yeah, I mean, typically, as a fund, I think your last fund was 150 million raised. Was that right, Roshan? I can't remember.
Yes, so we've got a couple different funds in total. There's just under £500 million of assets under management, and the last buyout fund was about 85 million value.
And you would expect with that fund to buy out 5 to 10 companies?
Yeah, that's right. Yeah, 5 to 10 companies, normally an enterprise value of kind of 10 to 20 million or so.
over a 2-3 year period?
Yeah, I guess our investing period from when the fund starts, we're trying to invest put that money to work in 2 to 3 years, work with the companies for another 3 to 5 years, and then look to exit those investments thereafter. So it's kind of a 7 to 10 year fund life cycle, I guess.
Okay, and we've had another question for you, which is from Philip. What sum would you typically expect an MBO candidate to put into a deal if you're backing them to do a deal? So, where the selling shareholders are really not interested in rolling over, it's being management led.
Yeah.
And what happens if they don't have the money? So what they call is hurt money, don't they? Hurt money. So, MBO candidate, we want to put some, because if they haven't put any hurt money forward, they're not motivated. What's your view on that?
Yeah, it's interesting. So that, I guess that's where management buyout, the phrase originally came from. The management team are buying out their shareholders and probably looking for some financial support to help them do that. But actually, it's evolved significantly. And today, a typical MBO is management team don't necessarily put any new money into the business. But what we do look for them to do is to roll over some of their existing value in the business. Yeah. So, typically a management team will have a shareholding in the business, either through options or shares. And that might be quite a small stake if there is a previous founder, owner, and vendor in the business. So, it might be 90% owned by the vendor and 10% owned by the management team collectively. So it's not a huge amount, but we do look for that management team to roll that value into the deal, effectively buying into the business on the same terms as us, and then to incentivize that management team, because having 10% for the next 5 years isn't really enough to incentivize people with the level of capital growth that they'll be looking for. To incentivize them, we obviously introduce sweet equity, which you very kindly defined and explained before, but basically giving the management team free shares, I guess, or allowing them to earn shares through the performance of the business over time.
And well, again, I guess it's a question for both of you. I'm going to go at, living with private equity after the deal. I've mentioned the word cultural to commercial, but Simon, you've got experience of a management team going through it. Are they finding it tough? That whole, right, you've got a business plan, you've got to deliver it, we've got to have a board meeting every month, we need better reports. Yes, your FD needs to tidy his act up, and if he doesn't or she doesn't, we're going to put one in. Quite a harsh change from, and I'm not saying SMEs are slack or emerging mid-markets are slack, but they don't worry quite so much about this stuff, do they? Reporting and
I think that's true. I think a lot of it comes down to how much ground is covered before a deal completes is important, and we encouraged our clients and the private equity to really talk through the expectations beyond completion. I think that is crucial, so that of course nothing's perfect, and of course there will be tensions, I'm sure, when things, with change comes challenge, doesn't there? You can't avoid all that completely. But I do think having, post-completion, as we call it, meetings, pre-completion, literally, it's got nothing to do with the deal. We're on our merry way doing the deal with the lawyers, and really encouraging to talk around how are we going to be working post-completion, who's going to be working with who, and who's going to be reporting to who, so that expectation's really met early on. Because drift off target too much here, but I'm a strong believer in cultural fit, and I think you really look to establish that very early in all transactions, because many deals work commercially, but they fall down because of cultural clashes, and I think and expectations that are different for each party. So I think dealing with those early on, I think is more likely to smooth that way when you do start to work together.
And that's key for us, is that we run auctions for trade, but also increasingly auctions for private equity. And I shouldn't really call it auctions, because there is almost a beauty parade. Roshan, you're lucky, you're good looking, it's fine. But, we don't just want to do the deal. We want it to work. We want to know we're going to get XXX, and we want to know that the private equity firm and the trade company share that vision of how they're going to do it. So it's not too painful. Otherwise, yeah, okay, the initial shareholders have pulled some significant value out, but it doesn't create the result you want.
And just adding to that, I think that's right. Maybe apart from the good-looking piece, so I guess what we really want to do is allow management teams to work on their business rather than in their business, which means yes, some investment in reporting, structures, systems, automation, things like that. But that's all around just making it easier to get the data points that you really need to be able to see where the value drivers are in the business, and for the management team to be able to make those decisions quickly and move fast. So there is a little bit of kind of scurrying around an investment in the first couple of quarters following an investment, or maybe even before, as Simon said, even better, to make sure those kind of systems and processes are in place. But the board meetings for us, it's about what's coming next, what's the strategic decisions that the management team need to make in the next 6 months, the next 12 months. It's not about looking at the last month and saying, oh, gross margins 0.5% off what you said it was going to be, tell me why. Because that, that's history, that's happened. We've looked at those numbers, we understand the reasoning behind them, but it's about how do we change the future? How do we make sure that we're making the best decisions we can to make the best of the business in the future?
And that business planning at the point of deal is something that's sort of misunderstood, I suppose, because the viewpoint is, well, if I'm going for a trade deal, it's their problem, and actually that isn't true. Far better to go on a trade basis into a room going, look, we've got a clear plan and a vision for this business. We think we might be sellers. If the price isn't right, we're going to keep it and take it to the next level. That then aligns it so you can explore both options at the same time. Or you may just simply have a preference for the growth capital or private equity, because you just want to see more involvement and the baby stay more independent and how it's going to do that. So but I really think the old days of, well, I'm tired of the business, I don't know what to do with it, I just need to sell, doesn't work, because both trade and private equity are looking for, well, what's the plan? And who's going to help us deliver it? There's a myth that trade have spare management. They can simply parachute in to grow your business. It's just not the case. So there is a real alignment there that if you're looking to sell a company, you need to prepare it for sale, and the business plan and the vision around that business plan, the market scope, the demographics, how big a sector it is going to be really important. Okay, so now private equity, I've said it, asset classes, as an asset class, the yield has been greater. Have you had any failures, Roshan? Where's it gone wrong for you guys? Living with private equity, where have you seen it going wrong? And have you had any actual corporate failures?
Of course, yeah, we have. And so we've got two investment models, I guess, at YFM. One is typically backing later stage businesses with £1 million profit or more. And the other one is backing earlier stage businesses which are typically pre-profit, but maybe have got a couple £1 million of revenue and are scaling fast. Now that investing in earlier stage businesses, clearly there tends to be a higher failure rate. Yep. And it's maybe it's 2 out of 10. In investing in later stage businesses, I wouldn't say there is a failure in terms of the value goes to nothing, but there is underperformance for sure. And I guess the question, how do we deal with that? So underperformance for us is as much our judgment as the business or as the market. And so it's not, again, it's not about saying, well, who caused this failure and it's your fault and you told me it was all going to be rosy, because we're realists, right? We make a judgment call on day one. If things don't turn out to be that way, then they don't turn out to be that way. And it's about, well, what do we do next to make this better? And so I think what we do well at YFM is we spend that time with businesses and the management team. So we've got 40 investments in our portfolio currently, and there's 20 people like me who spend time with management teams, investing and working with those businesses. So a kind of 2-to-1 ratio, which basically means we can spend a hell of a lot of time with businesses if we need to. Now, we're not looking to interfere or get in the way, but when companies do need support, then that's where we can spend a lot of time working with you to make sure things end up well. And then the final thing is we are long-term investors. So we talk about this kind of 3 to 5 years being important for investment life cycle. Actually, in our portfolio, we've held an investment for 18 years, I think is the longest period of time, which thankfully was a successful investment and delivered a good return. But the point being, we're not here to say, look, if it doesn't work out in 3 to 5 years, then we're going to forget about it. We're here to say, look, we will reinvest. We will keep making this a success. And hopefully that 18 years story tells you that can be true.
So Simon, before we sort of wrap up, Simon, you did another private equity, which was Aquafil, wasn't it? Now that was trade stroke private equity, wasn't it? So did you want to?
Yeah, I think just give that
a hybrid type model, which was
I think it's very easy to pigeonhole private equity in terms of the initial broader sort of answer is yes, they look to build it, they look to sell it, in a period of time. And I think I mentioned the hybrid earlier. Tarfix is an interesting one because they're not looking to sell it, and I think that suits it well. But the other elements of the deal were quite typical. Son is staying, and he's getting gifted, if you like, 10% shares, but he's the absolute right man to drive it on. Dad holds on to 5%. There's sweet equity pot, and there's an elevated part of the deal, and there's an option to cash in shares in 5 years if the business isn't sold, which is quite possible. But it isn't all around the typical journey. And then you've got you're right, the growth capital routes. We did deal with Aquatech to a company called Aquaspark, which gets quite confusing. We all got that in a muddle during the deal, but there we go. And Aquatech effectively, manufactured deterrent products to stop the fish and salmon farms being eaten by seals. World-leading technology, and coming up with lots of new technology going forward. Really exciting business. It was when I met them, it was not quite the right time to sell. It was a 2-year strategic work with them to pick the time we thought we should go to market, which was about June 2019. And he wasn't looking to sell. He's in his 40s. This was around, how do I get my business to get global reach with a product that's going to, it's world leading, but sooner or later I will run out of time. And I will get beaten. The competition will catch up and crack the code, if you like, to some degree. Aquaspark is a global private equity business that invests almost, not say exclusively, but predominantly in marine agricultural businesses worldwide. So they have got all of the right customer doors to open up for Aquatech. In that respect, it's a marriage made in heaven. It gives all of the ingredients of trade, but they're left to their own devices. It's a 30% investment, effectively, or 30% acquisition, just over. And of that, gives some de-risk money, a little bit of de-risk money to the client. But the key is it opened up all of the doors, and they also injected a few £1 million worth of growth capital, ring fenced in the business to drive it forward. So absolutely, marriage made in heaven for the client. In Aquaspark's position, just to clarify, they're not looking to get themselves into a majority ownership position. Most of their investments are minority. So all I'm pointing out here is there's very different. There's a lot of different investment routes available for clients to meet their needs, I believe, in the market than there ever was.
I'm sure if the French and the UK government put the investment they put into arguing about fish into just fish farming, we would solve the whole challenge. So, guys, I think it's been a really useful session. I hope as participants you've enjoyed that from a question point of view as well. Obviously, we've got a recording. That you'll have access to that if you want to share it with your clients or colleagues. Please do. We will send out that follow-up flyer of the possible exit options, elevator deal, growth capital, MBO, EOT versus trade, etc. So you can see some of the pros and cons, but it's different for everybody. I think very often it is just have an open mind, actually, is really the key to the question. Run a process, and we're lucky as a house, we can go in all of those directions. and you know, the process can help with the planning. So really good session. Really appreciate your time as well, Roshan, today with the Q&A, and we look forward to catching up with everybody soon. All right, have a great day. Thanks all.
Thanks, Kevin. Thanks, Simon. Thanks,
Thank you.
everybody.
Bye,
Have a good
bye,
day.
bye.
All
Cheers.
right. Bye.